boomtowns arose in heavy commodity exporting countries such as Canada and Australia. Yet as commodity prices started to fall, these economies took a massive hit. As a recent Capital Economics report reflects, 4 of the worst performing G10 currencies since mid-2014 have been commodity producers. Still, it would be wrong to assume that peaks and troughs hit at the same time, or that their damaging effects could force them all equally into a recession. Here to discuss the diverse range of opportunities that exist, Dr. Simon Evenett. Now, as I said, we knew the fall in commodity prices was coming and it would lead to a steep decline in trade. Doctor, why do you think these countries were better prepared?
Well, until the collapse happens, it's always a hypothetical, and you can't really motivate many policymakers to act on the basis of a hypothetical. So you don't get central bank reaction and like in advance of these types of adjustments. I think that helps explain why you see very little on the policy adjustment. As far as the firms are concerned, of course, let the good times roll until the train wreck happens, and then, of course, you get very sharp adjustments, as we've begun to see in the countries that you've mentioned. So I think both on the private sector and the public sector side, there's a real aversion to sort of preparing for the rainy day and enjoying the sunny day while it lasts.
Let's go into some specifics of what analysts at Capital Economics go on to say, and that's that oil prices will continue making a recovery. Those of iron ore and coal are going to fall back a little further, and dairy products are set to remain weak for some time, given that there is a multiplicity of options for many of these commodity currencies. Tell me, are we going to eventually just see potentially delayed yields rather than the immediate impact of a rebound collectively?
Yes, I think the uncertainty of the future course of commodity prices has got to factor in to what you think of the growth prospects for these countries. Of course, as you rightly imply, the commodities which are relevant for most of these different commodity exporters are different, and so the differential movements of those commodity prices are going to have an effect as well. I would add to your account of the different commodity movements, there's sort of rather negative sentiment expressed recently by Goldman Sachs on oil, suggesting that oil prices could go even lower. So I think we have a recipe here for one big feature of many of these economies going into the doldrums quite seriously. But again, it takes us back to that bigger point, which is that these countries don't just export commodities, they export a lot of manufactures too. They are exposed somewhat to East Asia, in particular Australia, which saw a big ramping up of its exports to that region between 2006 and 2013. And they do have domestic drivers of growth as well. So I think the commodity story will get a lot of play, but we must keep this in some sense of perspective.
Indeed, not a zero-sum game. Let's talk about monetary policy and the impact it's had on exchange rates. For instance, forecasters are suggesting that exchange rates have stabilized against the US dollar in the case of Canada as well as the Norwegian krone, but further depreciation is coming for the Australian and New Zealand dollars. So do you think that these governments in the latter examples are really ponying up to the fact that they really have to engage more deeply if they want to diversify and not fare as badly as unfortunately Canada's economy has done? I mean, it's facing in the midst of a recession.
These countries all have their own flexible exchange rates, and they're exploiting that to be able to cushion the blow. As you've implied, the currencies have fallen substantially in the last year or so, and we have seen monetary policy adjustments, certainly in New Zealand, although it should be said the Reserve Banks of Australia and the Canadian Central Bank have kept their rates constant. But that does provide them with a buffer. That ties nicely to your point about diversification, because to the extent that the central banks rely on devaluation and interest rate cuts to try and cushion the blow here, there may be less effort made by governments to try and diversify these economies. And so you may end up with the exchange rate taking all the pressure here.
How far do you think we can go where there's sort of this exchange rate buffer in place?
Well, I mean, in principle, exchange rates can fall substantially, and indeed potentially substantially more. I mean, there's nothing which would prevent, I think, another 10 or 15% fall in any of the currencies we're talking about.
That's very significant. Do you think that's what we can anticipate, sort of this inevitability, this instability that the exchange rate is going to face in the years and months to come?
I think the uncertainty and the instability is to be expected, and that will continue. I think precise estimates, though, of how far it's going to fall is probably a little bit unwise. I would go for a range, and I think range along the lines I described is probably quite reasonable, especially if the commodity price outlook is as pessimistic as you talked about earlier, and others have tried to confirm.